Hi there, and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to be here.
You know, if there's one thing that can really trip up seasoned investors and newbies alike, it's the ARV calculation.
Right, the after repair value. It's crucial for making sound investment decisions, but so many people make mistakes along the way.
Exactly. Today, we're diving into some of the common pitfalls in ARV calculations and how to avoid them.
We'll also touch on some practical tips that can help you refine your approach so you're not leaving money on the table.
Yeah, and we'll share some real-life examples too, which can really illustrate how these mistakes happen and how to steer clear of them.
That's right, and we'll look at the importance of doing your homework, like knowing your market and comparable properties.
Plus, we'll talk about the role of renovations in your calculations, how they can impact your ARV, and what to keep in mind when planning those.
It's all about building that long-term wealth, and understanding ARV is a big part of the puzzle.
So let's jump right in and start uncovering some of those ARV calculation mistakes.
Sounds good. Where do you want to kick things off? You know, Sarah, when we talk about ARV, or after repair value, it's not just some technical calculation. It really plays a critical role in a lot of people's financial futures, especially for those of us over 40.
Absolutely. I mean, at this stage in life, many are thinking about retirement, right? And if you miscalculate ARV, it could mean the difference between a comfortable retirement and scrambling to make ends meet.
Exactly. I've seen investors who, let's say, bought a fixer-upper thinking they'd easily make a profit, but they underestimated the ARV. In one case, a client of mine thought they could sell a property for $300,000 after fixing it up. But after doing the math, we realized it was more like $240,000. That's a big hit.
Wow, that's a serious miscalculation. It must have felt like a punch in the gut, especially when you're counting on that equity to fund your retirement.
Right? And it's not just about the numbers. It's about the emotional side, too. I mean, people invest in real estate for security, for peace of mind. If the ARV is off, it can feel like their plans are crumbling.
That's so true. And with inflation, it's more crucial than ever to make sure those numbers are accurate. Prices are rising, and if you overestimate the ARV, you could really be setting yourself back.
Yeah, inflation is definitely a concern. I was talking to another investor recently who bought a property in a neighborhood that was up and coming. They thought they'd cash in big, but with interest rates rising, the market shifted faster than they anticipated. The ARV dropped, and now they're sitting on a property that's worth less than they thought.
That's such a relatable scenario. Many of us have seen neighborhoods change, sometimes for the better, but sometimes it doesn't go as planned.
Exactly. And let's not forget that for a lot of folks over 40, this might be their last chance to build wealth before retirement. They want to pass something on to their kids, right? If they can't get the ARV right, they might miss out on that opportunity.
Yes, it's not just about them anymore. It's about the family legacy. I've spoken to listeners who are investing so they can leave something behind, whether that's financial security or just a property that can be a home for their children.
Yeah, and, with the current economic trends and fluctuations in the market, having a solid understanding of ARV can help protect against those swings. For example, if someone calculates their ARV based on old data, they might make a decision that's no longer viable.
Right, and sometimes it's easy to get swept up in the excitement of a potential investment, but taking a step back to really analyze the market can save you a lot of heartache and money.
Definitely. I've had clients who were so eager to jump in that they didn't take the time to research recent sales in the area. One guy was convinced he could sell his flip for a good margin, but when we looked at what similar houses sold for in the last 6 months, it was a different story.
It's like you said earlier, it's not just numbers, it's people's lives and futures. They might be relying on that investment for their retirement income or to help their kids afford college.
And that's a huge responsibility. I think it's important for listeners to realize that miscalculating ARV can have long-term impacts. It's not just a short-term setback. It can affect your financial planning for years to come.
For sure, and I think that's why real estate investing can be so daunting, especially for those just getting started later in life. The stakes feel higher,
Absolutely. But it's also important to remember that it's never too late to start. With the right knowledge and strategies, you can still build substantial wealth.
That's a good point. It's about being informed and cautious, but also not letting fear hold you back. You can still find opportunities, even in a challenging market.
Exactly. I've seen many investors turn things around by recalibrating their approach. They take the time to learn from mistakes and avoid pitfalls like ARV miscalculations.
And that's where the real growth happens, isn't it? When you learn and adapt.
For sure. It's about building a solid foundation so you can weather any storm. And with the right strategies in place, you can really optimize your investments and protect your future.
So, Mike, what are some practical steps that listeners can take to ensure they're calculating ARV accurately and effectively?
Well, let's dive into that. There are definitely tried and true strategies that can help investors avoid those common pitfalls. So when we talk about ARV, or after repair value, it's crucial to get that number right. It's really the backbone of your investment calculations.
Absolutely, Mike. If you overestimate the ARV, you could be setting yourself up for disappointment. Or worse, financial loss.
Exactly. A good rule of thumb is to look at comparable sales in the area, right? You want to find properties that are similar in size, style, and condition, and that have sold recently.
Yeah, and I think a lot of people forget about the recent part. Like, if a property sold 2 years ago, that might not be relevant anymore, especially in a rapidly changing market.
Right, so ideally, you want to look at sales from the last 6 months, maybe even 3 if you're in a hot market. And when you're assessing comparables, make sure to adjust for any differences. Like if one has a pool and yours doesn't, or if one is in a more desirable school district.
That makes sense. So it's about fine-tuning those numbers to get a realistic picture.
Exactly. And then there's the 1% rule, which is a simple way to quickly gauge if a property is worth pursuing. Essentially, the rental income should be at least 1% of the purchase price.
So if you're buying a place for $200,000, you should aim for rental income of about $2,000 a month, right?
Yep, that's it. If the numbers don't line up, it might be time to walk away.
And what about the 50% rule? I've heard that's another handy guideline.
Good catch. The 50% rule is a simple way to estimate your operating expenses. You take your rental income and assume that about 50% of it will go towards expenses. Things like property management, maintenance, and taxes.
So if you're making $2,000 a month in rent, you'd set aside about $1,000 for those costs?
Exactly. And then after that, you can calculate your cash flow and see if the investment makes sense.
This is all really practical. It's like having a roadmap, right?
Totally. And speaking of roadmaps, you should also have a deal evaluation checklist. I mean, it can really help you stay organized and focused when you're looking at multiple properties.
What would you include in that checklist?
Well, start with the basics. The purchase price, estimated renovation costs, and your projected ARV. Then include things like the neighborhood, school ratings, and even crime rates. It all matters.
And you can't forget about financing options. There are so many out there, and they can really affect your overall return.
Absolutely. For example, traditional mortgages might work for some, but if you're looking to flip properties, you might want to consider hard money loans. They can be more expensive, but are often quicker to secure.
Right, and that speed can be crucial in a competitive market.
Exactly. And then there's the potential for creative financing options, like seller financing or lease options. Those can offer flexibility, especially if you're just starting out.
So it's really about understanding all these tools and finding what fits your strategy best.
Exactly. And don't forget about the property types. Single-family homes might be a good starting point, but multifamily properties can offer better cash flow.
That's a good point. More units equal more income. Usually.
Right, and don't overlook commercial properties either. They might require more capital up front, but the returns can be substantial.
So, just to recap, we've got ARV calculations, the 1% rule, the 50% rule, a deal evaluation checklist, financing options, and property types.
Yep, that covers a lot of ground. But, even with all these strategies, there are still common pitfalls that investors should watch out for.
Oh, definitely. I mean, it's one thing to have a strategy, but execution is everything, right?
Exactly. One common mistake is underestimating renovation costs.
That's huge. I think a lot of people look at a property and think they can just slap some paint on it and call it a day.
Right? But it's usually way more than that. Always budget for unexpected expenses, because they will happen.
Yeah, I've heard that a good rule is to add an extra 10 to 20% to your renovation budget just for those surprises.
That's a smart move. And another pitfall is not having enough cash reserves. You really need a cushion for unexpected repairs or even vacancies.
That's so true. And in a tight market, vacancies can really bite into your profits.
Exactly. And don't forget about the importance of due diligence. Some investors rush through this because they're eager to close the deal, but skipping this step can lead to costly mistakes.
So taking the time to really understand the property, the neighborhood, and the numbers is key.
Absolutely. And lastly, I'd say don't get emotionally attached to a deal. It's easy to fall in love with a property, but if the numbers don't work, you need to be willing to walk away.
That's a tough lesson for many, I think, but in the long run, it's about building wealth, not just owning a property.
Exactly. So keeping these strategies and potential pitfalls in mind can really set you up for success in your real estate journey.
And it's all about making informed decisions, right?
Right on. So one of the biggest pitfalls I see, Sarah, is over-leveraging. When investors take on way too much debt, it sounds tempting at first, but it can really bite you later.
Yeah, I can see that. It's like you get this rush from acquiring properties, right? But then the bills start piling up.
Exactly. I had a client once who was really eager to expand their portfolio quickly. They bought 3 properties in the span of a year, each with high leverage. It looked great on paper, but when the market shifted slightly, they were overwhelmed with mortgage payments.
Wow, that must have been stressful for them. So what happened?
Well, their cash flow turned negative. They ended up having to sell one of the properties at a loss just to keep the others afloat. It was a real eye-opener for them.
That's such a tough lesson. But how do you avoid that kind of situation, besides just being careful with debt?
A good rule of thumb is to stick to a debt service coverage ratio, right? Aim for a ratio of at least 1.25. It means for every dollar of debt, you're generating at least $1.25 in income. Keeps you safe if things don't go as planned.
That makes total sense. Now, what about bad tenants? I imagine that's another common mistake.
Oh, absolutely. Choosing the wrong tenants can be a disaster. I had a friend who didn't do proper background checks. He was just so eager to fill the vacancy that he overlooked some red flags.
Like what?
Well, the potential tenant had a history of late payments. It seemed minor at the time, but once he moved in, it turned into a nightmare. Not only did he stop paying rent within a couple of months, but he also caused some damage to the property.
That sounds frustrating. So what's the best way to avoid that kind of situation?
Thorough tenant screening is critical. Check references, credit scores, and rental history. And, trust your gut. If something feels off, it probably is.
Good advice. And what about cash flow? I think many investors might overlook that.
Right. Cash flow is the lifeblood of real estate investing. I've seen investors get caught up in appreciation and forget to focus on cash flow.
Like, they're just waiting for the value to go up, right?
Exactly. I had another client who bought a property in a hot market, hoping to flip it for a profit. But they didn't account for monthly expenses. When the market cooled, they weren't prepared for the ongoing costs.
So they ended up stuck with a property they couldn't sell or rent?
Precisely. They had to hold on to it for much longer than they intended, draining their finances in the meantime.
It's wild how one oversight can snowball into a much bigger problem.
Yes! And then there's timing the market. That's a tricky one. Many investors think they can predict the highs and lows.
Oh, definitely. I mean, who doesn't wish they could time it perfectly?
Right? I remember a couple who waited to buy until they thought the market would dip. They kept saying, oh, it's bound to drop soon. But guess what? The market continued to rise for years.
So they missed out completely?
Yep. They got priced out of the market altogether. Instead of focusing on timing, it's better to look at long-term trends.
That's a solid point. And I guess hidden costs can trip people up too, huh?
For sure. Many first-time investors underestimate costs like maintenance, property management, and repairs. I had a client who bought a vintage property and fell in love with its character.
But then what happened?
Well, they didn't account for the plumbing and electrical updates needed. The renovations ended up costing way more than they anticipated, eating away at their profits.
Ouch! It's like that old saying, what you don't know can hurt you.
Exactly. Always budget for unexpected expenses. A good rule is to set aside at least 10 to 15% of your rental income for maintenance and repairs.
That's really helpful. So what can listeners do to spot these red flags early?
First off, educate yourself. Attend workshops, read books, and connect with other investors. Knowledge is power, and when looking at a property, do a thorough inspection.
And don't just rush in, right?
Right. Take your time, analyze the numbers, consider the long-term implications, and don't let emotions cloud your judgment.
Those are great tips. So, if someone finds themselves in a tough spot, what's the best way to recover or avoid getting into that situation in the first place?
Well, if you're already in a difficult position, it's crucial to reassess your strategy. Can you refinance? Or maybe consider selling if it makes sense. And always have an exit strategy.
That's a smart approach. So, it's all about being proactive rather than reactive?
Exactly. And for future investments, build a solid team around you. Real estate agents, property managers, and financial advisors can provide invaluable insights.
That's such an important takeaway. Surrounding yourself with the right people can really make a difference.
Absolutely. Remember, real estate is a long game, and it's all about making informed decisions that align with your financial goals.
I love that. It's about building a sustainable investment strategy, not just chasing after quick wins.
Yes, and that's how you build long-term wealth in real estate.
Well said, Mike. Shall we dive into the next steps for listeners?
Let's do it. So, now that we've talked about common pitfalls in ARV calculations, let's dive into some actionable steps that listeners can take right now, right?
Absolutely, Mike. It's all about making this practical, isn't it?
Right. First off, I think it's vital to get familiar with some essential tools. Apps and websites that can really streamline your process.
Yeah, definitely. One that comes to mind is Zillow. It's a great resource for checking property values and recent sales.
Exactly. And you can also look at the Zestimate feature, which gives you an estimated market value for properties. Just remember, it's a starting point, not the final word.
Right. And if you want something a bit more tailored for real estate investors, the BiggerPockets calculator is fantastic. It helps you analyze deals and see if they make sense financially.
Yes, that one's a game changer. You can run different scenarios, play with numbers, and really get a feel for the potential return on investment.
And then there's DealCheck, which is similar but has its own unique features. It's user-friendly, and you can compare properties side by side.
For sure. And let's not forget Rentometer. If you're looking into rental properties, it gives you a quick snapshot of average rents in an area, which is super helpful for calculating cash flow.
Totally. And if you have access to your local MLS, that's like having a treasure chest of data at your fingertips.
Definitely. The MLS gives you the most accurate and up-to-date information on properties in your area, which is crucial for making informed decisions.
So once you've got these tools, what's the next step?
I'd suggest starting with a simple checklist. Just jot down the key factors you want to consider for each property. Things like the location, property condition, and comparable sales.
And don't forget about renovation costs. That's a big one when calculating ARV.
Exactly. Also, try to analyze at least one deal a week. It keeps you in the practice of evaluating properties, and you'll get more comfortable with the numbers over time.
That's a manageable goal. One deal a week sounds doable for most people.
Right? And if you're feeling a bit stuck, consider joining a local real estate meetup. Networking with others can provide insights and inspiration.
Oh, I love that idea. Meeting like-minded people can really boost your confidence and open your eyes to new strategies.
For sure. And if you want to dive a bit deeper, reading books or listening to podcasts can also be beneficial.
Yeah. Do you have any book recommendations, Mike?
One classic is The Book on Rental Property Investing by Brandon Turner. It covers so much, from finding deals to managing tenants.
That's a great choice. And I'd add Real Estate Investing for Dummies. It breaks everything down into digestible bits, making it perfect for beginners.
Right. And for podcasts, definitely check out the BiggerPockets podcast. It's packed with stories and strategies from successful investors.
I love that one. It's always inspiring to hear how others have navigated their journeys.
Exactly. It helps you realize that everyone starts somewhere, and it's okay to learn along the way.
That's so true. And remember, small habits can lead to big changes. Just starting with one analysis per week can really get the ball rolling.
Yeah, and as you get more comfortable, you can increase your frequency or even start looking into different markets.
That's a great thought. Expanding your horizons can really open up new opportunities.
And don't forget to stay organized. Keeping track of your analyses in a spreadsheet or a notebook can help you spot trends over time.
Absolutely. Plus, it's a great way to look back and see how far you've come.
Right. And as you build your knowledge and confidence, you'll find yourself making more informed decisions, which is key in this game.
So with all these tools and habits in your arsenal, it feels like you're really setting yourself up for success, doesn't it?
For sure. It's all about starting where you are and gradually building up your skills and knowledge.
And that's what makes this journey exciting. Every step you take is a step toward your financial goals.
So those are some practical first steps. Now let's bring this all together. So as we wrap up today's conversation, let's quickly recap some of those key points about ARV calculation mistakes to avoid.
Absolutely. First off, it's crucial to really understand what ARV is, right? It's that after repair value, and getting it wrong can really impact your investment decisions.
Exactly. And the importance of using comparable properties. I mean, you can't just pull numbers out of thin air. You have to look at what similar homes in the area have sold for, especially after renovations.
Yeah, and let's not forget about factoring in the costs of renovations. If you're too optimistic about how much those will be, you might find yourself in a tough spot later on.
Right. And, also keeping an eye on the market trends. You know, the market can change, and if you're not aware of those shifts, your ARV could be way off.
Yes. And lastly, it's always a good idea to consult with professionals, whether that's a real estate agent or an appraiser. They can provide insights that might save you a lot of grief.
Well said, Sarah. Now, looking beyond the numbers, building wealth through real estate is a journey, and it's one that's absolutely achievable, especially when you learn from these mistakes.
Definitely. It might feel daunting at times, but every step you take gets you closer to your goals. You just have to stay focused and keep learning.
And speaking of learning, we'd love to hear from you. If you enjoyed today's episode, please like, subscribe, and let us know your biggest takeaway or any questions you have in the comments.
Yeah, and don't forget to share this with someone you know who's over 40 and interested in investing in property. They might find it really helpful.
Next time, we're going to dive into forced appreciation strategies beyond cosmetic.
Ooh, that sounds exciting.
It really does. Thanks for listening, everyone.
Take care, and we'll catch you next time.